Well, if we aren't going to stay in all the tech leaders and the stay-at-home stocks, and the reopening are already getting rich, what should we do?
Well, the market overall has pockets of very expensive stocks, and we've seen what happened with the group that's Peloton, Zoom, Airbnb, DoorDash, Palantir. Those stocks have come down since the fall because they just got ahead of themselves. You know, great companies, but selling at high multiples of sales. So now we've had the reopening trade since September, and of course, airlines, hotels, casinos are going to have a big boom in business compared to what they had for the whole COVID year. That doesn't mean, though, that the stocks continue to go up forever. And you hear so many people talk about their enthusiasm for the cyclical or value trade. But most of the sectors of the market are trading at around 23 or 24 times forward earnings now. If you look at industrials, which were very depressed last year, they're 24 times earnings. So cat and deer sell at the same multiple as Facebook and Google. And the tech stocks are selling at 25 times next year earnings. And they have obviously some expensive names in there. So, you know, you can have a bit of a pause in the cyclicals, which we in fact saw with technology. The technology stocks peaked at the beginning of September, and they sort of went into this lull, and they're still down. The big names are down from where they were in the fourth quarter. They had a tough quarter in the fourth. They've had a very tough year so far. They're up about 2%, and cyclical stocks are up anywhere from 8% to 20%. I mean, you look at a day yesterday, for example, where the airlines were the best performing group, and many of them were up, 8 to 10%. But the financials were down. So there's a lot of rotation as investors are sort of seeking the level where it's all right to buy the stocks, even if we think they've gone up, or perhaps they've come back in, such as, the big tech names. And we find that many of them are attractive right now. But it doesn't mean the whole market is expensive. It's just that you have to be careful about where you continue to put money and not just follow the crowd.
All those multiples you mentioned in the past, you mentioned multiples like that, and you at least feel like you're at the high end of the range, right? I mean, those aren't numbers where you're like, wow, this is great. And with rates going up, whether it's slowly or over time, should that be something to keep in the back of your mind?
Yeah, definitely. So the market as a whole, I mean, if you look at 2022, I gave you the year that's current now for the next 12 months. 2022 is trading at about 18.5 times earnings. And the numbers for GDP keep going up. So I suspect most analysts are looking at 6% GDP growth for this year. That is a very, very strong year. It could even be higher. And of course, that's relative to last year. But if you look at history, we just looked at the last 50 years where GDP was over 4% or it was a post-recession year. And in those years, for all of them, except for one, which was 2000, the S&P was up. Now, you could say, well, look at what happened in 2000. Is that what's happening today, where we have extremely high-priced stocks? And, that was the dot-com bubble bursting. And so many of the high-priced stocks at the top of the capitalization table had no earnings at all. The big names that are at the top of the S&P are the big, Apple, Amazon, Google-type names. They have lots of earnings and huge cash flow. It doesn't mean you shouldn't be careful, and I understand the point. I mean, we have watched as the electric vehicle cars, for example, they've gone to, 40 times sales. The percent of stocks selling for multiples of sales more than 10 times is really pretty high compared to periods in the past where you had, 10 billion, 20 billion market caps in these names that, no earnings and lots of value and excitement. Have to be careful of those stocks. And, Joe, many of them have come down. If you look at, Peloton, Zoom, Snowflake, CrowdStrike, DoorDash, you pick your name, MongoDB. These names didn't exist a year or so ago, and they had parabolic moves and have come down anywhere from 15 to 35%. So the market has adjusted. But yes, you're right, 22 times forward earnings is not cheap. And interest rates at this level, yeah, very low. Are they going up? They're going up. I think we're going to hear this week that the Fed has no intention of moving them aggressively at all. I mean, the market is trying to figure that out. And that's one of the big questions, that taxes and inflation. But we don't think that rates are moving very far.
Shepard Smith here. Thanks for watching CNBC on YouTube.